All righty. Good morning, everyone. Good morning to those on the West Coast, and good afternoon to the rest of the country. My name is Jason Rosenkrantz, and I work for BackNine Insurance and Financial Services. Today, we are very excited to have Tom Wong from Protective joining us. He'll be going over what is new and great at Protective, along with providing a few selling points to help increase your Protective sales. And finally, before we begin, I just wanted to let everyone know that they will be muted during the presentation, and afterwards I will be contacting each of you personally to reach out and answer any questions or comments you may have. And without further ado, if you're ready, Tom, take it away.
Good morning and welcome, everyone. Thanks for taking your time to attend this session. Hopefully we'll provide you with some ideas to help you grow your life insurance business. Before we begin, I'd like to take a brief moment to give an update on Protective's unique custom choice UL product. This is a term alternative product that's unique in the industry. As of Monday, October 26th, we have reduced our rates on this product for the non-tobacco and select preferred and non-tobacco classes across the board. So Protective is usually in the top 3 to 5 ranking price-wise among the carriers. Although having a competitive price is an important element, what's more important in the long run is having products that deliver value to clients. So what do we mean by value? Some key words come to mind such as worth, usefulness, advantage, benefit, gain, and profit. Protective's products are designed to provide the utmost value to clients. We'll see some of these examples in some case studies. So let's begin. First case study, we have a lady named Sandy, and the agent have met with Sandy and determined that in her untimely death, Sandy wants to be able to provide for her family to pay off her mortgage, take care of ongoing expenses until her children are graduated from college and out of the house. So what type of product design will be available for Sandy? Sandy meets with her agent, and together they decided a 15-year term will best meet her needs. If we go with the typical sales process of looking for the lowest price available, the agent would offer MetLife with a premium of $304. Notice how small of a difference the annual premiums can be. Now, with your typical process of looking for the lowest rates, things don't happen as planned. Life happens and things change. If Sandy needs coverage for a longer period of time, what will happen to her 15-year term plan? She'll be faced with annual renewable term rates. Next slide, let's show you what happens. 15 years later, Sandy's son still lives at home. She continues to be dependent on Sandy. To continue coverage with MetLife, the premium in the 16th year will go up 1,462% to $4,700 $49. If Sandy purchased a 15-year term, custom choice term with Protective, the premium is only $5 more annually. At the end of the initial period, she can continue coverage for up to a lifetime at a decreasing face amount with no change to her out-of-pocket costs. Now, this aligns with Sandy's initial strategy because she expects her needs for life insurance to decrease over time after her children have left the household. But since it's taken a little longer than expected, the flexibility of Protective's custom choice UL design allows her to keep her coverage in force and meet her needs. And look how much cheaper the price is per thousand if you look at the cost per thousand column on the right-hand side. Now, if Sandy's agent chose a different approach and chose the Protective Custom Choice product, her benefit will be completely different. Now, the next case study, we have Mark, 45-year-old male, 3 kids, ages 13, 11, and 9. Now, Mark meets with his agent and determines that he needs $100,000 income for his spouse for 20 years and also $450,000 to pay off the mortgage and other obligations, and $50,000 to take care of final expenses. So the total amount is $2.5 million that's required. Now, based on the idea of choosing a product by price, MetLife would probably be the choice at $3,294. But was that the right choice? Considers the same quotes, but adding Protective's income provider option. Now, this option is available on all our UL products. There's no additional charge for this product, Rider. Not only is the annual premium lower, but Mark could assure that the death benefit could be paid out to the beneficiaries over a customized period of time. So we're talking about providing $100,000 a year for 20 years. Now, the effect of this income provider option is that it has a discount on the premium. So now you see that the premium is $2,571. Because the custom choice UL is built on a UL platform, even more flexibility and value will be provided. For example, there's a 61-day grace period, option to roll over 1035 money into the policy, and there's an evidence-free exchange, somewhat like a conversion within the first 20 years and prior to age 70. And the policy can be converted to a no-lapse guarantee UL product. And in addition, because this is a UL-based policy, we don't have to factor out any policy fees for commission payment, unlike your typical term policy where up to $70 may be subtracted from the commissionable premium. Here we have a case study with long-term needs. We have 44-year-old David who's married with a 16-year-old daughter. David and his agent identify that he needs a 20-year coverage. Okay. So what product would be best for this particular case? So we're looking at $500,000 of death benefit. The typical sales process involves, if you're looking for the lowest price possible, American General would be the choice. It's about $100 cheaper annually. But once again, life happens. Things don't work out as planned. Clients don't fully understand the implications of paying premiums early or skipping premium payments. Flexibility isn't what they have thought. So all these factors may create a frustrated policyholder. So let's jump forward. At age 55, David's daughter, now 26, loses her jobs and moves back home. He needs to skip premium payments so he can get her daughter back on her feet. At age 65, life happens again. David has unexpected medical expenses. He skips premiums again. So let's see what happens. With the low-risk premium product, the American General policy, the death benefit guarantee reduces to 84, whereas with the protective products, custom choice and advantage choice, guarantee is due to age 100, even after skipping premiums in year 11 and year 21.
Hey, Tom, I have a question for you. Is the death benefit affected at all when they skip the premium?
No, the death benefit is fully intact.
Very nice.
Fully intact. The only thing that's impacted is the guarantee period. So the original guarantee period on the previous slide was to age 105 for all these carriers. And now with skipping 2 premiums for all these carriers, skipping the 11th year and the 21st year, the guarantee for protective, instead of being 105, is still to age 100. Now the American General policy was reduced from age 105 down to 84. Significant impact in the reduction of the guarantee period. Is that clear on that?
Mm-hmm.
Okay, let's continue. So why protective no-lapse guarantee ULs? We have strong guarantees even when life happens where premiums need to be skipped, or even if on a GUL, sometimes in the older policy designs when somebody pays premiums early, that will have a negative impact on a policy performance. With our guarantees being based on a specified premium approach rather than shadow fund, that's not going to have a negative impact. So paying premiums early will not have any effect on the guarantees. Our products are built with catch-up provisions. So for example, if you initially guaranteed coverage to age 90 and the person still living, they can extend the coverage beyond 90 by paying a higher catch-up premium. Lastly, I want to show you an approach using our index UL product. So we have a male 45 in good health, married with 2 kids. Now Steve wants to build up a plan that have values to help pay for his kids' college. So flexibility and cash value is important. Protection for income replacement in the event of untimely death is valuable to Steve. So he understands how the performance of the S&P 500 might impact the cash value growth of his policy. But at the same time, he feels that the premium that he's going to be paying into the policy should meet his needs. Your typical sales process here, most agents will obtain an illustration from a carrier, and the carrier will be illustrating a default interest rate. And this is what we're showing here in this slide. The premiums are quoted here shows the default interest rate and the cash value resulting from these kind of projections. It appears to have, the Nicola appears to have a low premium of potential cash value, which really comes in handy when Steve's two kids are in college. But is this the best approach, using the default interest rate? Eye-catching returns on projected interest rates in the future. When interest rates drop, the performance you will find will be adversely impacted due to higher internal expenses that most of the carriers are showing that you may not be aware of. So let's continue here. So Steve is now 65. Market volatility occurs over the last 20 years, and the policy rates have fluctuated. As a result, the expenses are internal expenses are eating away the cash value at an alarming rate. He's concerned he can't contribute to the kids' college expense, something that was originally important to Steve. So what does he do now? A more practical approach, instead of using high illustrated rates and caps that appears to be competitive, we can show him a more conservative approach using a 5% interest rate, solving for $1 cash value at age 105. With this, he can account for some of the market volatility, but still offers Steve the opportunity for upside potential with lower policy expenses. So let's see what happens with this approach. Back up a little bit here. So with the interest rate set at 5%, you see that the protected premium is now $4,091, and the guarantee is to age 98 rather than 105. And this approach provides a good balance of cash value and premium and guarantees. Now, I want to demonstrate here how conservative rate of 5% at solving for $1 cash value at age 105 can outperform a policy with John Hancock's Protection UL. With protective index product, by using a conservative interest rate of 5%, we're matching the premium for John Hancock's Protection UL at $13,791. In the 20th year, our cash value is 76% higher, and the death benefit guarantee is 19 years longer. Okay, this is due to lower internal expenses, and you don't see that when the high interest rates are illustrated. In fact, we have a marketing piece, and Jonathan and Jason and BackNine can provide this particular piece to you. But what it shows is that when is 0% crediting greater than a 5% crediting rate? Now, we have compared John Hancock's Protection UL We set it at 5%, matching the premium at $13,734. And in the 20th year, our cash value is higher. Death benefit guarantee is to age 105 rather than 86 for the John Hancock product. And this is illustrating at 0% interest rate. So this piece is available in BackNine. Can share this piece with you after the session. I'm going to show you the illustration here. In the 20th year, it's $185,000, and the piece that will be available to you will reflect that. So why use Protective IVOL? It's a more realistic approach using lower internal expense charges, upside potential with downside protection. It's a very simple approach. We only have one index, S&P 500 annual point-to-point. Nothing complicated, very easy for agents and clients to understand. This concludes our presentation. I'm open for questions at this point.
All right, Tom. Thank you very much for your time this morning. I and BackNine, we appreciate you filling in on such short notice for Chris. And just as a final reminder to all the attendees today, I will be reaching out to everyone individually to, again, answer any questions or comments and provide you with a copy of the webinar for your records. And with that, on behalf of myself and Tom, we want to thank you very much for attending and have a great rest of your day. Thank you.
Thank you, everyone. Have a great day.